markets have arrived at a significant crossroads. Central banks have done a lot of heavy lifting with policy stimulus and promises of further stimulus over the course of the second half of 2019 to counteract trade rhetoric negativity. They've successfully supported asset prices, and if we do have an abatement of the trade war, we anticipate that there's going to be a natural adjustment higher in interest rates, and that will produce a little bit of a total return drag on government bonds. So spread products should outperform in that environment, but we're still walking a very narrow path here to a successful outcome of a soft landing as far as the fixed income markets are concerned. So if we do take another lurch down the road to a potential recession sooner than expected, we anticipate that lower quality credit is going to struggle to keep pace with good performance from investment grade and very high quality, high yield bonds. So therefore, you won't be surprised to know that that's where we think the sweet spot is for 2020. In terms of investor expectations for growth, they're still quite low for the year 2020. We're looking at tepid growth consensus forecasts across both the US and the Eurozone, not to mention still decelerating growth in China. And in that environment of low growth, low inflation, we're very much still priced for a world that doesn't experience a significant burst of growth or burst of inflation. So if we do see inflation running out of control in 2020, and what we already perceive to be as a fairly balanced or perhaps even very relaxed central bank attitude towards the economy running hot, at least when it comes to the US Federal Reserve, that could produce a very significant reaction in interest rates, and investors are not prepared for that at all at the moment. We're very closely monitoring sectors like energy. Investors are starting to treat a lot of these assets as if they are stranded or unnecessary, and therefore the capital structures that are not sustainable or have sufficient liquidity to grow into the new paradigm in the energy markets with a bigger balance in renewables are going to suffer and perhaps struggle to survive. So on the negative side, we're thinking about those spaces. We've seen a lot of positive developments really for the European financial system. In particular, it still has a long way to go to being properly capitalized relative to US competitors. Growth rates in Europe are still reasonably insipid. However, the banks have done a lot to boost their capitalization, boost their profitability, and national champion institutions within significant strategic Eurozone countries are looking like a very good risk-adjusted income opportunity for our portfolios.